Dear students, hopefully all of you are doing very well. Today we'll talk about international corporate finance. I'm Dr. Sharat Khandekar and I will give you the lecture. So first of all, I'll talk about the chapter overview. So the chapter overview includes to be familiar with the international finance terminology, apply exchange rates and cross rates, understand triangular arbitrage and covered interest rate. We'll also distinguish between the purchasing power parity, interest rate parity, unbiased forward rate, uncovered interest rate parity, and some other effects. We'll also look at the NPV calculation for the foreign operation in home country and foreign country approach, and I will also explain the exchange rate risk and other political risk. So let's go to the lecture. First of all, we need to understand the domestic versus international financial management. So wherever there is a transaction involved more than two currencies and the level of and the possible changes in exchange rate need to be considered. So what does it mean? So we need to consider when we are doing an international transaction, what about the transaction and the exchange rate, and we need to also consider the other factors. The risk of losses associated with action taken by foreign government also need to be considered. So what happened to the international operation? How friendly the international governments are? And we need to think about the political risk in that country where we are going to set up an operation for our business. And we also need to think about the opportunities in the international capital market and the instrument that might be required for us for the funding activities. So when we talk about the international financial market or the international financial management, we need to think about different types of terminology, and we need to familiarize with ourselves with the different terminologies as well. For example, the cross rate. The cross rate is an exchange rate between two currencies quoted in some other third currency. So that's the cross rate. So for example, in Australia, when we're talking about the cross rate, so what is the exchange rate of US dollar and Australian currency and US dollar with the British pound sterling, and when this rate is quoted in Australian currency, that is a cross rate. The second terminology which is important for us is called the euro. So the euro is the monetary unit for the European monetary system or the EMS. Third is the euro bond. Euro bond is an international bond issued in multiple countries, but basically it is dominated in the issuer's own currency. Euro currency is the monetary deposited in the financial centers outside the countries whose currency is involved. And gilts is a British and Irish government security. Foreign exchange market is basically the market in which one country's currency is traded for another, which is the foreign exchange market. Foreign bond is the international bond issued in a single currency, issued in a single country, and usually dominated in their country's currency. Foreign bond is an international bond issued in a single country, usually dominated in the country's currency. LIBOR is the London interbank offer rate, and the rate is the most international bank change one to another for the overnight euro dollar loans. And the last one is the swap, which is an agreement to exchange two securities or the currencies. Now, in the foreign exchange market is a very important market for us, and this is the largest financial market. In the international financial market or the foreign exchange market, most trading takes place in few basic or the large currencies, and the US dollar is the most dominant currency in the foreign exchange market. Other dominant currency in the foreign exchange market includes euro, British pound sterling, Japanese yen, and Swiss francs. And the participants in the market includes the importers, the exporters, portfolio managers, foreign exchange brokers, traders, and speculators. In the international market, foreign exchange is a very important factor because all the international transactions are happening every day is based on the foreign exchange rate, and this exchange rate can change every single moment or over the time. So let's put a question. If you wish to exchange $100 for a British pound at an exchange rate of, say for example, $1 equivalent to 0.675 British pound, how many pound will you receive? So we have $100 and we want to exchange this $100 to the British pound, and how much we are going to get. So if you convert 100 Australian dollar to British pound, the exchange rate is 0.675, which is given in here, and if you convert it, you'll find it 67.5 British pound sterling. So the second question, you paid 20 French francs for the croissant in France. If the exchange rate is $1 equivalent to FF 4.1184, how much did it cost in dollars? So we know that $1 will purchase 4.1184 French franc, and we need to have 20 French franc. So how much it will be in Australian dollar? So it's very simple. We'll just divide the 20 French franc by 4.1184, and that is the answer what we're looking for. So the exchange rate quotation is also plays a very important factor. So as an international student, when you go to a shop or bureau de change, foreign exchange trader, to exchange your currency, and you'll find that the rates are quoted in two different ways, and generally it's showing it's like this way. Now this is the exchange rate quotation for American dollar against the Australian dollar. Now the two rates are given in here. So $1 Australian is equivalent to 0.8215 to 0.8190. Now if you wonder, if you go to a bureau de change and then you want to convert 100 Australian dollar to American dollar, which currency you'll go, how much you're going to get? Think about it. Now in this rate, as you can see, the two rates, and this one is a bit lower and this one is a bit upper. So this rate, the lower one, is the rate at which the dealer sells US dollar or buy Australian dollar. So at which dealer sells US dollar. So when the dealers will sell the US dollar, it means you will buy that one. And this rate, which is 0.8215, rate at which dealer buys US dollar. So when the dealer buy US dollar, you'll sell US dollar, or sell Australian dollar, or they'll sell Australian dollar and then you'll buy the Australian dollar. That's how it goes. So for example, if you want to buy some US dollar, so they will sell the US dollar, you are going to get this rate. If you wish to convert 1000 Australian dollar to US dollar at the above exchange rate, then what will happen? So if you go back to the slide, you'll find that if you want to buy the US dollar, it means the dealer will sell, then the rate will be 0.8190. So if you look at it here, so it is 0.8190. So if you want to sell the US Australian dollar, therefore you want to buy the US dollar. So the dealer will buy the Australian dollar, or they will sell the US dollar to you. So if they sell the US dollar to you, it means that you will get 0.8190. So 1000 Australian dollar multiply 0.8190, so which will be US dollar 819. Now if you want to convert this, which the dollar you just get it, so US dollar 819 back to Australian dollar, then you are going to buy the Australian dollar, therefore the seller will sell the Australian dollar. So when the seller will sell the Australian dollar, so that's right, the seller sells Australian dollar, then the rate is 0.8215. So it is 0.8215. So you just converted 819 US dollar from $1,000. So now you're converting it back to Australian dollar. So 819 divided by 0.8215, that will be equivalent to Australian 996.96. So the difference is the dealer's fee. So $1,000 minus 996.96, so it's $3.04. So that is your loss, or you just lost $3.04 because of this transaction. So this slide is about the arbitrage definition. So arbitrage opportunity is the opportunity to buy an asset at a lower price than immediately selling it to a different market for a higher price. So that is the arbitrage opportunity. For example, if you buy an asset for $10 in China or from Chinese market and sell it to through the eBay and sell it for $20, so you made $10 profit out of this transaction, and that is called the arbitrage. So the definition of arbitrage is buying an asset at lower price and selling it immediately without holding it to a higher price. So what is triangle arbitrage? So the triangle arbitrage is a process of converting the currency to another currency and convert it again to a third currency. So it's like, that's why it calls triangle arbitrage. So from Australian dollar you're converting it to US dollar, from US dollar you're converting it to, say for example, the British pound sterling, and then convert it back to Australian dollar. So that's what it said in here, that finally convert it back to the original currency within short period of time, and that's called the triangle arbitrage. So let's look at definition for that. So you're having the following exchange rates. So 1 Australian dollar is equivalent to 10 French franc, 1 Australian dollar is equivalent to 2 Deutsche Mark, and Deutsche Mark versus the French franc exchange rate is 4. So step 1 is you're going to buy 1000 French franc for $100 because the exchange rate is 10. You can look at it in here. And then you're converting this French franc to Deutsche Mark, so you'll get 1000 francs equivalent to 250 Deutsche Mark because the exchange rate is 4. You can see it in here. So you get 250 Deutsche Mark, and from 250 Deutsche Mark you're converting it to Australian dollar. So 250 Deutsche Mark is equivalent of 125 Australian dollar. 200, so you can see that 1 Australian dollar is equivalent to 2 Deutsche Mark. So we got 250 Deutsche Mark here. So 250 Deutsche Mark divided by 2 is 125 Australian dollar. So you initially had 100 Australian dollar, which converted to French franc to 1000, and then 1000 French franc is converted to 250 Deutsche Mark, and then 250 Deutsche Mark is converted to 125 Australian dollar, and by this process, or called the triangle arbitrage process, you made $25 profit. So what is the cross rate? So the currency exchange rate between two currencies, both of which are not the official currency of the country in which the exchange rate are quoted, is called the cross rate. For example, the exchange rate between US dollar and euro quoted in Australian newspaper called be the cross rate. And we can get the exchange rate quotation through this way. So this is the exchange rate quotation from an Australian newspaper. So you can look at in here in the retail market, the exchange rate has been given. Okay, in the wholesale market, the spot rate has been given, forward margin has been given, cross rate of the major currency, you can see the cross rate between this has been given. All right. So for example, US dollar to pound sterling stock cross rate is this, US dollar to yen cross rate is this, you have been given, and euro dollar deposit rate has been given. So this is the exchange rate quotation normally presented or published in the newspaper daily. So let's look to an example of a cross rate. The Australian dollar can be exchanged for 10 franc or Deutschmark dollar 2. So the cross rate must be 10 FF divided by 2 DM, which is equivalent to 5 French franc equivalent to 1 Deutschmark. So the exchange rate of the British pound and the Japanese yen would be, so Australian dollar is buying 0.3538 British pound sterling, for example, and 1 Australian dollar is purchasing 63.74 Japanese yen. So the cross rate between these two would be 180.16. Now, when we're talking about the cross rate or the international market transaction, we're talking about the different types of exchange rates. Generally, there are two basic types of the deal in the foreign exchange market. One is called the spot deal, and the second one is called the forward deal. The spot deal is an arrangement to trade currencies based on the exchange rate today for the settlement within 2 business days. The exchange rate on the spot deal called the spot exchange rate. So you need to do the settlement within 2 business days. On the other hand, the forward deal is an agreement of exchange currency at some time in the future and generally within 12 months. The agreed exchange rate is called the forward exchange rate because you are fixing the rate for the forward price, and it is basically within 12-month period. So it's called the forward deal. Now we also need to understand what is called the purchasing power parity. So the PPP, or the purchasing power parity, is an idea that the exchange rate adjusts to keep the purchasing power constant among the currencies. The absolute purchasing power parity is, or PPP, a commodity cost the same regardless of what currency is used to purchase or where it is selling. For example, if the beer costs $1 or if the beer costs £1 in London and the exchange rate is 0.4348 per dollar, then the beer cost £1 divided by 0.4348 is equivalent to $2.30 in Melbourne. So a beer which costs $1 in London, that should cost $2.30 in Melbourne, and that is called the absolute purchasing power parity. For the absolute purchasing power parity, we must need to make sure that the transaction cost must be zero, there must be no barrier of trade, the item purchased must be identical in all locations. For the absolute purchasing power parity, we quite often use one index, it's called the Big Mac index. So you know the Big Mac, which is quite famous burger in McDonald's. So across the globe, all the Big Macs are the same in weight, the same taste, and the Big Mac index is actually showing us that what is the purchasing power parity in different countries. So I would suggest you to go to Google, write down the Big Mac index, and then you can find out what is the price of Big Mac across the globe in different countries and currencies. So then what is the relative purchasing power parity? So the relative purchasing power parity is the idea that the changes in exchange rate between two currencies is determined by the difference in inflation rate between two countries. So the relative PPP tells us what determines changes in exchange rate over time rather than explaining absolute level of exchange rate. And there is a formula to calculate the relative purchasing power parity. So look at the formula. So the relative PPP, the equation is this one, which is E in the bracket ST equal to SO. SO is the current spot exchange rate, multiply the bracket 1 plus HFC. HFC is the foreign country inflation rate minus HA is the inflation rate in Australia, close the bracket, power T. T is the time. Okay, and E in the bracket ST is the expected exchange rate at time T. So let's do a calculation. For example, the German exchange rate is currently 1.3 Deutschmark per dollar. The inflation rate in Germany over the next 5 years is estimated to be 5% per year, while the Australian inflation rate is estimated to be 3% per year. What will be the estimated exchange rate in 5 years? So as we know, the Deutschmark will become less valuable and A will become more valuable. Why? Because we know that over the next 5 years, the estimated inflation in Germany will be 5% and estimated inflation rate in Australia will be 3%. So if you can calculate the estimated relative PPP, that will be the exchange rate. So estimated exchange rate will be is currently the spot rate, which is this one, 1.3 multiply then 1 plus 0.02, close the bracket, power 5. Now where we get 0.02? Because the exchange rate in Australia, because the inflation rate in Germany will be 5%, in Australia it will be 3%, so 5 minus 3 is 2%. Though the current spot exchange rate is 1.3 Deutschmark, but it will be in 5 years time it will be 1.4353. So that is the example of relative purchasing power parity. Interest rate parity. Interest rate parity is a theory that states the interest rate differential between two countries is equal to the percentage difference between the forward exchange rate and the spot exchange rate. So it also explains the relationship between the spot exchange rate, forward exchange rate and the interest rate. So that is called interest rate parity. So let's look at an example. So the interest rate parity can be calculated using this formula. So the formula is the following. So FT is basically forward exchange rate for settlement at time T. SO is the current spot exchange rate. RFC is the nominal risk-free rate in a foreign country. RA is basically nominal risk-free rate in Australia. Let's look at an example. Suppose the exchange rate for Japanese yen SO is currently 75 equal to 1 Australian dollar. If the interest rate in Australia is RA is 9% and interest rate in Japan is RJ is 4%, then what must be the forward rate to be prevented covered in interest arbitrage? So if we put all this information in our formula, so we know that spot exchange rate is 75. 1 plus, as we know that for the foreign currency the interest rate is 4% and the interest rate in Australia is 9%. If you solve that equation, you will find that the interest rate parity should be 71.25. Hopefully you understand this calculation. International capital budgeting. So in all of our slides, we talk about the international markets, the exchange rate parity, we talk about the international financial markets, and how we do calculate the exchange rate using different factors. Now here we'll talk about the international capital budgeting, and we'll basically look for two different approach. One is called the home currency approach, and second we call the foreign currency approach. So what is international capital budgeting? So for example, one Australian company is having a subsidiary in Hong Kong, and how we will calculate NPV in Australian dollar is if the company is in Hong Kong. How we'll calculate the NPV in Hong Kong dollar as well. So we need to calculate the home currency as well as the foreign currency approach in order to do the international capital budgeting. Let's look at an example of international capital budgeting. Pizza Shack is considering opening a store in Mexico. The store costs $500,000 or 3 million pesos, which is in Mexican currency. Now the exchange rate is $1 is buying 6 Mexican peso. They hope to operate the store for 2 years and then sell it to a local franchises. Assume that the expected cash flows are 2,500 pesos, 2,500,000 pesos in first year and 5 million pesos in year 2, including the selling price and of the store and fixtures. The Australian risk-free interest rate is 7%, and the Mexican risk-free rate is 10%. The required rate of return in Australia is 12%. Ignore taxes. So we need to do the international capital budgeting in this scenario. How we are going to do that? So method 1 is the home currency approach. In the home currency approach, what we're going to do, we're going to calculate everything in the home currency. And in this case, our home currency will be the Australian dollar. So we know the initial investment is 3 million pesos, which is negative, so it's cash outlay. Year 1, we receive some cash, which is 250,000 pesos, it's cash inflow. And year 2, we have 5 million pesos, which is cash inflow. These are the expected exchange rate. Now year 0, the expected exchange rate is 6%, or currently the exchange rate is 6%, and cash flow in dollars is $500,000. Expected exchange rate in in year 1, we need to calculate it based on the formula. So how we're going to calculate it? So as we know, the spot exchange rate is 6, then 1 plus the rates in Mexico is $10. We can look at it back. So we can see that the Australian risk-free rate is 7% and the Mexican risk-free rate is 10%. So if you go back, we can see the expected, inflation rate is 10% in Mexico, and Australian dollar in Australia is 7%. And then close the bracket, power T. So we can calculate the expected exchange rate would be 6.18. So current exchange rate is $6. Expected cash exchange rate would be 6.18. How we're going to do that? How did we find it out? We calculated in this way. For year 2, we calculate the spot exchange rate should be 6.18. So instead of 6, it will be 6.18 for year 2, and then we put the same thing again. Then you will find that what is the expected exchange rate for year 2. So based on that, we calculated that 250,000 pesos is equivalent to to 40,453 Australian dollar. Year 2, the cash inflow is 5 million. Then we calculate the expected exchange rate, which is 6.3654. Then we convert to an Australian dollar, is this amount 785,497. So that is the cash inflow. So first one is the cash outflow, next one is cash inflow, and we do the NPV calculation, and we calculate based on that. In Australia, the risk-free interest rate, the required rate of return in Australia is 12%. So we put it 12% in here, and then we calculate the NPV. We find the NPV is 162,312. So that is the NPV in home currency approach. The method 2 would be the foreign currency approach using the 3% inflation premium. So the foreign currency approach would be, as we know, first of all, we have the cash outflow, or initial outlay is 3 million peso. We put 3 million peso in here. Year 1, we'll have 250,000 peso as inflow, and year 2, we have 5 million peso as inflow. Okay, so year 1, we calculate what is the inflation premium in that case. So we calculate this way. So 1.12 multiply 1.03. Why 1.03? That is the risk premium, and there's the required rate of return minus 1. Then we calculate 15.36. We get it 1.5336 year 1, and 1.1536 power 2 is year 2, and expected return, and then we calculated based on that. We find that 973,871 pesos is the NPV. So if you can calculate this amount to the current exchange rate, the current exchange rate is $6. We calculate this one, and then we find that it is 162,312, which is exactly equivalent to 162,312 using the method 1. So either you're using the home currency approach or you're using the foreign currency approach, it should give you the same result. Hopefully you understand this calculation. However, as we calculated the international capital budgeting using the home currency approach or even the foreign currency approach, it is giving the same result in both the cases. We need to understand few other things. Number 1 is unremitted cash flow, because some country they can actually block the foreign remittance or sending the remittance to the home country, because for a foreign subsidiary they can remit or pay out funds to the parent company in several ways. So one is through the dividend, as we know. Second could be the management fees for the services, or number 3 could be the royalties on using the trade name or the patents. Alright. However, some government can actually block it, and then it could be difficult for a subsidiary to send the or to pay out the cash amount to the home country, and that's called that's called the risk of sending the unremitted cash flow. So the risk related to having international operation in the world where the currency values are vary, there are 2 different types of exposures we need to look. One is called short-term exposure, and second is called the long-term exposure. The short-term exposure is the uncertainty arises from day-to-day fluctuation of the exchange rate. For example, short-term export and import situation when you cannot hedge the fund. So day-to-day exchange rate fluctuation, and it can be it could be a serious risk for a country where they have a higher political risk or higher stability risk. And the long run exposure is the potential losses due to the long run unanticipated changes in the relative economic condition in two or more countries. For example, wages condition in China and India. So that could be a long run exposures. There could be another exposures which is called the translation exposures. So what is a translation exposures? So the translation exposure is an uncertainty arises from the need to translate the result from foreign operation to the home currency for accounting purposes. So for the accounting purposes, how to translate this result of the foreign operations. For example, in the case of significant foreign operation in various time of the year, or profit decreases in terms of dollar due to the inflation in the foreign currency. So for example, if Australia have a significant foreign operation in Vietnam and there is a huge, there is a significant changes of the exchange rate throughout the year, that could be a translation exposures. Now remember, the short-term exposures or the long-term exposures or even the translation exposures could be affected by the political risk of a country. Now, what is a political risk for a country? For example, changes in value due to the political action in a foreign country could be a political risk. Changes in the legislation could be political risk. Political instability of a country where a significant foreign operation is held could be a political risk. So investment in a country that have an unstable government should require a higher return. For example, if anyone want to invest in Afghanistan, for example, or some African country, so that might can create a significant political risk. So the type of the political risk could be very much depending upon the nature of the business. For example, if an automobile industry, they want to set up a manufacturing plant in India or in Bangladesh, where to set up a manufacturing an automobile industry, so the setup cost could be huge. Or for example, if an Australian company goes to Africa and they do a lot of ground working to find out the minerals from the soil. Now, if there is a huge political risk there, the cost could be very high because it costs a lots of money to do the groundwork of developing the mining resources. So the political risk should be carefully monitored when investing in a foreign operation. There are different types of political risk, what we can see in the international market, which can include the currency devaluation, increased taxation, blockage of the fund, loss of the property due to the future cash flows, terrorism. So these are the different types of political risk that we can see in the international market. That's all for today. Hopefully you like the lecture. If you like it, please make sure you subscribe to my YouTube channel. Thank you very much for watching this video. Bye.